want to keep in your library. It's kind of like the Edwards and McGee chart pattern books that have been around and have been time tested. And what this pattern does is it's a visual graphic demonstration of price and time symmetry. And it actually contains 4 consecutive price swings in this market. Okay, and it resembles a W at the bottoms and M's at the tops. Okay, now after this X is formed, you're going to get your basic ABCD pattern. Okay, now here's a case where we're looking at the ABCD of an emerging pattern. You can tell it's emerging because this arrow is gray. Okay, that means that AutoChartist has made this forecast that based on the combination of this projection here, this pink line, and this blue line coming down here, and also off of point B, that the market could go up to this dot. So when you're working with emerging patterns, when you say you're in a position that's long or short, if you want to look at where the market could go, it's best to go to emerging patterns. If you're flat the market and you're looking for something to enter, you want to go to the completed markets. So in this case, AutoChartist is making a forecast that if this is going to follow same symmetry that we've seen, that it could go to this dot. And then once it hits here, then it could go on to a retracement. All right? So that's real important. It indicates, again, a reversal because what's happening here, higher tops and higher bottoms means it's trending up. But AutoChartist says when it hits here, it could reverse. So it's a reversal pattern. The other thing is, since you know ahead of time where it could go, you can gear up your position because you know where the exit is. So you can get in a little earlier or faster than anybody because you have this price identified ahead of time. All right? You can be more proactive than reactive. And that gives you an opportunity to place a stop, tighter stop, and the tighter you can place that stop, the better your risk-reward ratio can turn out to be. All right, so hopefully we're not going to follow the same trend that we have been following, and that we'll get a good Gartley pattern. What's good about splitting these patterns up into the individual patterns is because once you learn the characteristics, if you know the characteristics of the market and what the tone of the market is, then what you can do is you can go and pinpoint almost exact areas or exact patterns that are going to be significant. So right now we have no fresh signals in this for the Gartley pattern for stocks, so we'll go to the FX majors and see if there's something taking place there. A lot of times it's repetition that helps you become a successful trader. You want to be able to know a few patterns and know how certain equities trade, for example, or know how certain indices trade, how they trade on report days, how they trade on weekends, how they trade earlier in the week. If you learn the characteristics of these things and then you learn the mathematics or the characteristics of the pattern, then they all come up earlier. They all become better and easier to trade, and you get more success. So it looks like the complex patterns are not that significant today. So we'll look and see at some of these patterns from the past. All right, this one was predicting a move to point D. Looks like the level was right on price, but the time was off by a couple of days before the market made its break. So that wraps up the webinar right now. So what we could do is I can look at some of these questions we have, and I'll leave this up on the stock indices, and we'll take a look at that ABCD pattern because that seems to be the most popular. And as the stocks begin to emerge and trade, we'll take a look at if any patterns are taking place right now. So I will look at some of these questions here, and I'll answer them as I come along. All right, let me blow the screen up a little bit. And all right, see what we have here. All right, first question is, let's see here. Can someone give indication of the topic stop loss? Well, I guess that means how you would use the program for a stop loss. Definitely, I'm adhering to the rule of always use a stop loss. And this may sound a little bit different, but I suggest that you find your stop first, or find your exit first, and then find your entry. If you see that oftentimes systems and programs and traders are always get in the market, they can find a place to get in, and then they scramble for an exit or a reason to get out. What I'd suggest is that you find your exit first. And typically what you want to do, like for example, if you're following an ABCD pattern, when you get the signal here that D is forming, all right, and you want to go counter trend, all right, obviously the first stop is this point under D, because what it represents is that a point where the trend will turn. And again, this is for trading. If you're investing, there's a different strategy. Now, as this market begins to move up and makes another swing, all right, and then continues on up, you may want to trail under this particular swing, all right? And as long as this market keeps making these higher swings, you want to continue to move your stop up, all right, until eventually you'll be taken out. From a bigger picture, there's different ways to trade also, but the main thing is when you catch a turn on a swing, you want to use the immediate or the highest or lowest level as your main exit. All right. Question here is another question coming up is so you suggest to stick to 50% and 62s. Yeah, I do. I prefer that because I see that as the most common area. Besides, it just seems to me more, especially 50% points. They seem to be like a magnet sometimes and attract the market. So again, that's my personal preference to the marketplace. If a market exceeds, for example, if we're rallying, if it trends down and we're rallying up into a 50% 618, what I'll do is, if I don't just put an order out there and say, okay, if it gets up here, I want to get short, because I'm not a passive trader. I don't passively offer the market, and I don't passively bid. What I do is I let the market go through the price, and if the trend's down, I'll wait for it to come back through my number, and I'll short in the direction of the momentum. Okay, you kind of have to see it as I do it, but that's because I watch order flow, and what a lot of times is the market will go up because there's no big trader in the way, but then on the way down a big trader emerges, and so I sell it back through the price I would have originally sold it at. I never just put an order out there just because there's a number there, and that's my trade, my style that I've had success with in the past. All right, how many pips should that movement be, and when will it be, this pattern become invalid? We're not counting pips here, but when you're looking at an ABCD move, I think you're talking about if it goes through a 50% or 618. In this case, you know, since you're working basically with a ladder here, you'd have to look at the kind of risk reward that you're used to looking at, and if the distance seems to be too great between 50% and 618, then you'll have to pass on the trade. But as I said before, is just because if the trend's down, when the market's down here, I just don't stick an order here. I wait for it to stop and then begin to move back down, and I hit bids when I get short, and if I get long, I hit offers. I don't mind paying up if momentum's in my favor. All right, so if you could see that the market did stop a little bit at 618 before heading through, but eventually what happens is all these patterns become our momentum patterns and volatility patterns. So if you get auto chartist, you should look to see if you can get it in the as a MT4 plugin, because you'll be able to see or use momentum indicators such as the ATR or volatility indicators to help you become a better trader. All right, so let's see. I'll just got a few more questions here. I think we're going to run out of time. We are recording this webinar. It's going to be up on the website. I suggest that you spend some time on the website because we are looking at, we do write some pretty good pieces there on how to use this, and also on the market conditions each day. Let's see, what do you think is riskier, to enter on an emerging pattern before the last major move or after the pattern has completed? Well, as far as riskier, well, I would assume that just looking at how an emerging pattern takes place, is that an emerging pattern is most likely a little bit riskier, because you're not too sure if this pattern is actually going to finish. For example, here's a case where AutoChartist got the direction right and the time right. Again, here's where the symmetry of time and price. But what happened is the market didn't rally up to this price. Okay, so from a risk standpoint, I look at it two ways: the risk of missing the trade, that's one risk, and the risk of being wrong on the trade and losing some money. So in this case, if I was waiting for my price, I didn't get it. But it looks like the time, look at how the market turned right on that time period. So yeah, I would I tend to be personally I get a little bit more upset when I miss a move, because I played around for a few pennies here and there. So basically I consider it to myself as an error of omission. But in this case, you can see that if you're waiting for an emerging pattern and you want all the conditions to work out perfectly, time worked but price didn't. All right. Now, in some cases, you may get filled and then the market may go through. All right. That doesn't bother me either, because these are small identifiable areas. Okay. We're not just arbitrarily picking levels, that there is some mathematics involved in it. So as long as I keep my losses small, I don't get too upset about it. And as far as risk is concerned, you have to risk something to be in the game, except that you want to make sure your risks are relative to the amount of money you trade, and that the stops make sense, so that if I'm wrong, the patterns change. And that's it for today. Thank you for coming to the webinar, and enjoy the weekend. And we'll be doing another webinar next week and for next few weeks. Go ahead with that.
Thanks for your time, James. That was a great session. And we're all looking forward to next week's webinar, where we talk about AutoChartist's Power Stats feature. Thank you, everybody.